Hi class, today we're going to look at problem 4-5A through, 4-5B through 4-8B. I'm going to share my screen with you. And you should be able to see now 4-5B. What we're going to be doing is we're going to be doing a payroll register for Hogan Thrift Shop. And the payroll register is going to be for employees who are paid weekly. The marital status and the number of allowances claimed are shown on the payroll register. You need to know what the marital filing status is when you are calculating your federal income tax. You also need to know that each employee's weekly salary is on here. And so these are weekly salaries, which has remained the same all year. And so each person's going to receive the same amount of the weekly salary every week in the year. Complete the payroll register for the payroll period ending December the 20th, which is the 51st weekly pay date. The state income tax rate is 3.1% of total earnings. The city income tax rate is 1% of the total gross earnings. And we're going to use the wage bracket method for federal income taxes. They're telling you here to enter all amounts as positive numbers, and you're going to round your calculations to the final answers and the final answers to the nearest cent. And so we're going to be using the tax table wage bracket method, and this is the link for it right here. Now, there's several employees that they have on this payroll register. And so what I'm going to do for you is just the first example, because the remaining examples are done exactly alike. So it'll cut down the length of this video greatly if we just do a few of these. But if I do one example, the rest are done basically the same way. So I'm going to start with Ken Gold. He is married, filing jointly, and he doesn't have any withholding allowances. His total earnings are $1,900 per week. And so one of the first things that I did, just to make sure that they don't go over the OASDI base, because we're going to have to calculate OASDI taxes first, is I would take $1,900 and multiply it by the number of pay periods to see if it even gets close to the base. Remember, there's a ceiling for OASDI that we've talked about previously. And the amount of the wages at 51 pay periods is nowhere near that ceiling amount. So that means that all of these employees are under the ceiling amounts for the year, since they're all less than $1,900. So what we need to do is figure out the OASDI taxes. And what you'll remember is that we have to multiply the weekly earnings of $1,900 times the tax rate for OASDI, which is 6.2%. And that will give you $117.80. That is the amount of the OASDI tax. It's always a good idea to check your work, just make sure your math is correct. And we are this time, so we'll move to the HI taxes. So I'm going to take $1,900 and multiply it by the tax rate of 0.0145 or 1.45% for HI. And that will give you $27.55. For the FIT, which is the federal income taxes, then what we have to take in consideration now is the filing status is married filing jointly. The amount of the weekly wages, which was $1,900, and we're using the wage bracket tables. And we're going to use the standard withholding for the 2020 rates for this wage bracket method. So I'm going to click on here. Click on the link to bring up the tables. And then we're going to scroll through the tables until we find the wage bracket method. We want the weekly payroll period, which is tax table B. And I'm going to expand this so I can see it. I'm going to enlarge the image. And we're going to look for the amount of the weekly pay, which was $1,900. It's got to be at least, but not more than $1,900. So I'm going to scroll down the column. You can see in the first table, it goes to 750 to 760. That's not enough. So I'm going to scroll across because there's a second part of the columns here. And let me scroll up so you can see where I'm talking about. We need to go at least 1,900. So I will keep going down. I don't see it down here. So we're going to scroll on down. And this table won't do it. So I'm going to close this table out. And I'm going to scroll down to the next table. I'm going to enlarge it so I can see what we're doing. And I'm going to look for at least, the salary was $1,900. So the salary is $1,900. So I'm going to go, you see there's one right here with $1,900 on it, but it's better to get more taxes withheld for the employees so that they can get a refund if they need one. So I'm going to go down here. It's at least $1,900. That is the amount of our salary in this case, to $1,910. It's not more than $1,910. So I'm going to scroll across and I'm going to pick up $164. And let me scroll back up so you can see where I'm getting it from. This is married filing jointly, the standard withholding. So right here is $164. So I'm going to go back to Cengage. I'm going to put in $164. I'm going to check my work. And that is the correct amount. So I'm going to also need to calculate the state income tax. So they have given us in the instructions the state income tax rate, and that rate is 3.1%. So you're simply going to multiply 3.1% by the wages of $1,900. And that will give you $58.90. And we're going to check our work. And then indeed, they're looking for the city income tax. The city income tax is 1% of the gross earnings. So 1% times 1,900 is $19. And that's your city tax. So in the last column, they want you to find the net pay. The net pay would be your gross earnings minus each one of these items, these taxes, and that will leave you with the net pay. So 1,900 minus $117.80 minus $27.55 minus $164 minus $58.90 minus $19 gives you a net pay in the amount of $1,512.75. And we're going to check our work. So that's how you calculate the taxes for this particular company. There's a second part to this problem, which is calculating the employer's tax. So as a review, you know that we have to take out taxes on our employees, and then we have to pay Social Security taxes and Medicare taxes. The employer has to pay those, or those are the FICA taxes that the employer has to match. So for your OASDI taxable earnings, since none of these went over the ceiling for OASDI, all of these are the taxable earnings. And it would be the same for the HI taxes. And then what we would do is we would multiply the total earnings, 6837.05, times 6.2%. And that will give us an amount of $423.88, and 90 cents, rounded. And I would check my work just to make sure that's right. And then we're going to take our taxable earnings of 6837.05, and we're going to multiply that by the HI tax rate, which is 0.0145 or 1.45%. And that gives you $99.14. And we're going to check our work. And that's how you would calculate the employer's FICA taxes. So I'm going to move to the next problem. Which will be 4.06b. And on this problem, it says Youngstown Company, a Massachusetts employer, wants to give a holiday bonus check of $750 to each employee. Since it wants the check amount to be $750, it will need to gross up the amount of the bonus. Calculate the withholding taxes and the gross amount of the bonus to be made by Jenna Fredericks if her earnings for the year are $55,920. Besides being subject to Social Security tax and federal income tax at the supplemental rate, notice that says the supplemental rate. So when we're using the bonus rate, the supplemental rate is always going to be 22% for federal income taxes. And a 5.05% Massachusetts income tax, which must be withheld on supplemental payments. All right, so what they're trying to do is they're trying to give each employee an amount of $750, and that's after the taxes have been taken out. So there's a formula that you will need to use to be able to figure out that grossed up amount for the bonus. They want the gross amount of the bonus. So it's got to be more than $750 because they want the employee to have a net amount of $750 here. So I've created an Excel spreadsheet for you. And so I'm going to switch to that for just a second. And you should be able to see that Excel spreadsheet that I've calculated for you. And what I did is I copied the problem down and some information about the problem that are going to be important. And I've noted those in red. So when you get ready to answer the problems in Cengage, make sure you enter the deductions with a minus sign. If you don't do that, Cengage will calculate it wrong. Also, you may need to adjust by a penny, either subtract or add a penny to the gross amount to get the net pay to calculate exactly to $750. So there might be some rounding errors that are part of this. So first of all, the formula for this particular problem is in your textbook. So you want to look at your textbook for the formula. And the formula is basically, we're going to take the amount of the intended payment, and we're going to divide that amount by 1 minus the applicable tax rates that are combined. So the hardest part is figuring out what the applicable tax rates are. So what I've done is I've shown you individually how the applicable tax rates are, what they are, and all you got to do is add them together. So we're going to start with our FICA rate, which you know FICA consists of both OASDI, which is your Social Security portion of the FICA, and also Medicare, which is 1.45% or HI. So FICA, the OASDI rate is 6.2%. What I did is I went ahead and converted this to a decimal. So 0.062 is 6.2% converted. You just move your decimal 2 places to the left. HI is 1.45% or 0.0145. There's a flat income tax rate on bonuses, and that flat rate is 22%. There's also a state income tax rate for Massachusetts, and that tax rate was given at 5.05%. So this is the decimal part of 5.05%. So what you have to do first of all, before you can find the grossed up bonus amount, is you have to add all of these tax rates together. The combined total of the tax rates is 0.347. This is going to be subtracted from 1 or 100% if you want to think of it like that. If we subtract 0.347 from 1, it will leave us with our denominator amount for our formula, which is 1 minus the applicable tax rate. So to find the grossed up bonus, you take the amount that you want to pay the employees after the taxes have been taken out, which is $750. You're going to divide this $750 by the 1 minus the applicable tax rate, or the denominator figure of 0.653. Once you divide that, you're going to get the grossed up amount of the bonus, which is 1148.545. Now, in Cengage, they took it to be 1148.54. But I would have rounded it to 0.55. But that's where this, you might need to adjust it by a penny, or either by adding a penny or subtracting a penny, comes into play, because there was a rounding effect to this particular problem. And so then I want to show you how to prove this, because a lot of times students don't understand what's going on with the grossed up amount. But what we're saying is the gross pay would be this amount right here. So if we multiplied each of our tax rates by each of the taxes that we have withheld, these are the individual taxes. So we would add all of these individual taxes up to get a total taxes that would be deducted for this problem of $398.55. Those total taxes subtracted from the gross amount will leave you with $750. So that's how we prove it. Now in Cengage, they actually wanted you to record the amount of the grossed up amount. And so I got 1148.55, but technically they used 1148.54. So I'm going to go back to Cengage and show you what would happen there. Let me make sure that's the right amount again. I'm going to switch back and forth. I'm sorry, class. 1148.54. All right, I'm going to check my work. And you can see that when I did it on Excel, I got 55. So when I first did this, I entered 55 in and then it was wrong. That might frustrate you, but it did tell you in your instructions to adjust it by a penny. And that's why they reduced it back to 0.54. Technically, you wouldn't be wrong if it was 0.55, but Cengage will grade it wrong. So I don't want that to worry you. The next thing they're asking for is the federal income tax that was withheld. And I'm going to go back to my spreadsheet again to pick up the federal income tax amount. And you can see here that it was $252.68. And to keep me from flipping back and forth, I'm going to write these down because they're going to ask you for the federal income tax. They're going to ask you for the state income tax, which was $58. And they're going to also ask you for the HI tax, which was $16.65. And they're going to also ask you for the OSDI, which was $71.21. So I'm going to jot those down so we won't have to flip back and forth, but these were the taxes and how they were calculated. So I'm going to go back to this. Now I'm going to put in my federal income tax. Now remember, the deductions would be your taxes, and you got to enter the deductions with a minus sign. If you don't do this, it marks it wrong. And so I'm always receiving emails from students on this particular problem because they don't put their minus sign in. So I'm going to emphasize to you, you must put a minus sign in for Cengage to count this right. The federal income tax was $252.68. And again, I'll provide you with that spreadsheet. I'll post it with the videos so you'll see where that amount comes from. The OSDI tax was $71.21. You got to enter it as a minus because it's a deduction. The HI taxes were $16.65. Enter it as a minus 2. And the state income tax was $58. Got to enter it as a minus 2. So I'll check my work. All these calculations were correct. And so if you take this and you subtract all these from it, your take-home bonus amount of the check should be $750. And that's all you do to this one. So there is a formula to find the grossed up amount. You can find that in your textbook, or you can look at my spreadsheet, and hopefully that will help you. So I need to go to the next problem, which is 407. All right, on this problem, it says Jen Miller made 1,090 this week. Only Social Security is fully taxable. Federal income taxes attached to her pay. Miller contributes $125 each week to her company's 401k plan and has $40 put into her health savings account, which is non-qualified, set up for non-qualified expenses each week. This non-qualified is very important in solving this problem. Since it's non-qualified, a health savings account means that this amount is taxable. If this had said a health savings account that was qualified, qualified means that the expenses are related to the health care account, then you would have been able to deduct this. So this right here is the key to getting this problem right. It's non-qualified. And a health savings account is set up basically to help employees pay for deductibles, because insurance deductibles on healthcare plans are pretty expensive these days. So if you need some help in paying for that deductible amount, a way to do this is to set up a health savings account. But the key here is it has to be a qualified health savings account in order to be able to be deductible for federal income taxes. In this case, since it's non-qualified, we can't deduct it. So it's fully taxable is what I'm trying to say to you. And then her employer also matches this $40 each week. So the two main things in this problem are that to figure out before you can figure out what your federal income tax is going to be, which is what they're asking you to do here, is to determine whether this amount is taxable. And if it's contributing, if you're contributing to a 401k plan, usually that comes out of your paycheck before any federal taxes are taken out. So that when you retire, at retirement, when you reduce your 401k plan, then you're taxed at a lower tax bracket. So this is a way to encourage citizens to contribute to their retirement plan. And so Jen is contributing $125 each week to the 401k plan, which means she can deduct this amount and not have to pay taxes on it now. But when she retires and takes the money out, then they'll pay taxes on it. Hopefully she'll be at a lower tax bracket at that point in time. So the two keys are 401k plan and the HSA account, or the health savings account. All right, first of all, you need to enter in the gross pay. And her gross pay is $1,090. They really didn't tell us what day or what week this was during the year, so we're just assuming that this 1,090, probably if you calculated that by 52 weeks, is nowhere near the ceiling. So we're just saying that all of this is taxable for the FICA taxes. So I'm going to put in 1,090 as the gross pay. Then we're going to put in the HSA contributions. And right here, you see the employer is going to put $40 in, but also she's going to have $40 taken out of her paycheck for this contribution. So this is her contribution. Jen Miller contributed $40. That is her contribution. Now, remember that deductions have to be entered with a minus sign or this is going to count wrong. So I need to put a minus sign in front of this to make this right. So make sure you read all your instructions carefully. So I'm going to check my work, and then we're going to look for 401k deductions. That's what they want next. And she was contributing $125. So make sure you put in a minus sign there. And then now we need to figure the OASDI tax. This is your Social Security tax, and all of that 1,090 is taxable for OASDI. So we need to make some calculations. 1,090 times 6.2% is $67.58 minus $67.58. And then 1,090 times 0.0145 or 1.45%. That'll give you the Medicare taxes, which you have to round up to $15.81. Make sure you put the minus sign in front of the amount. And now here's your FIT. What's different about FIT is we don't go on the gross pay. What we're going to do is we're going to take the amount of the gross pay and we're going to deduct out what she paid in for the 401k plan, which was $125. The amount that is taxable is $965 for federal income taxes. So to find the amount, you're going to have to look it up on the wage bracket methods. But before we do that, we need to look to see if she's married, how she's, what her, excuse me, I was about to sneeze. It about got me anyway. Certainly allergy weather now. I apologize for that. I hope I don't sneeze on you. But anyway, for the FIT, we have to see whether she's married filing jointly, and she is. So we're going to use the wage bracket method. She's married filing jointly. That's something important that we need to take into consideration. And so I'm going to go to the wage bracket method, and I've got this, oops. This will take just a second. It didn't like me clicking on it again, evidently. We're going to go to the wage bracket method. This person was paid weekly. So we're going to look at enlarge the first tax table, and the amount of her taxable wages for federal income tax purposes were $965. Again, that was $1,090 less the 401k plan deduction of $125. That leaves you with $965. It doesn't fall in this column, so let's see. Yeah, we're going to be able to use this this table this time. So let's scroll up. First of all, you need to know it's married filing jointly. We're using the standard withholding. Find the amount of pay that falls in between. Her pay that was taxable was $965. So from 960 to 970 is where that would fall. It is $51. So I'm going to go back to Cengage and I'm going to put $51 in here. And that's the FIT. All right, and then you're going to find the amount of the net pay, which is the gross pay of $1,090 less all the deductions. So $1,090 minus 40 minus 125 minus 67.58 minus 15.81 minus 51 leaves you with $790.61. All right, so on this problem, you have to understand what a health savings account is. And this term right here, non-qualified, means that it's subject to federal income tax. You can't back it out. But the 401k plan is not subject to federal income tax right now. It will be when Miller retires. And so I'm going to move on to the last problem. And on the last problem, they have you filling out a payroll register again. And I'm just going to do the first one with you with the highest amount of pay so you can understand what's going on. But I'm going to caution you on some other things. So if you'll just bear with me while we read through this. The names of the employees of Matson Office Systems and their regular salaries are shown in the following payroll register. Note that Wayne and Young are paid monthly on the last payday, while the others are paid weekly. That's a key there. Wayne and Young are monthly, while the others are paid weekly, so watch out for that. In addition to the regular salaries, the company's annual bonus is based on the amount of earnings for the year. So we're going to give them a bonus. So we probably need to talk about how to calculate that bonus in just a second. For the current year, the bonus amounts to 8% of the annual salary paid to each employee. The bonus is to be paid along with the regular salaries on December 27th. So sometimes when you pay bonuses, they can give you a separate check and not combine it with your regular paycheck. But in this case, they're combining it with the regular paycheck. It says, but the amount of the bonus and the amount of the regular salary will be shown separately on each employee's earnings statement. Assume that all employees receive their regular salary during the year. Prepare the payroll for the pay period ending December 27th, showing the following for each employee. You're going to first of all use the wage bracket method to withhold the federal income tax from regular salaries. That's a big key here. You're using the wage bracket method to withhold federal income taxes from the regular salaries, what they're regularly paid each month or each week. Then you're going to withhold a flat 22% on the annual bonus. Now, there are two methods which you could have done this that are described in your book. This is method B, where they're saying we're just going to withhold a flat 22% on the annual amount of bonus. But I feel like I need to mention to you that there could have been method A, which is where we would add the salaries and the bonus together and then find the federal taxes on both of those amounts combined. But they didn't do that. They separated the bonus from the salaries. And so the bonus is going with method B, where they're getting a flat 22% tax rate on the annual bonus. What I mean by flat tax rate is that we'll just take the amount of the bonus and multiply it by 22%, and that's how they'll come up with the federal income taxes. The total salaries and bonuses are subject to a 2% state income tax. So they're going to combine the two together to get the 2% income state tax. And they're also subject to a 1% city tax, where the bonuses and the salaries are combined together. So they tried to make this a little bit trickier for you, but it's really not that bad. First of all, you need to figure out what the supplemental earnings are, the amount of the bonus is. Remember that it was 8% of the regular pay. And since this is the monthly pay, first of all, I would take the 3,000 and multiply it by 8. And that would give you the amount of the bonus. So 3,000 times 0.8% gives you a bonus of $240. So again, let me check. It's 8% of the, it's 8% of the annual salary paid to each employee. So let me back up a minute. Got to find the annual salary first. And so what we would do is we'd take 3,000 and multiply it by 12 months. The annual salary for Wayne or Brett Wayne is $36,000. That's the annual salary. We'll multiply it by 8%. And that will give you 2,880, which is the supplemental or the bonus amount. So I'm going to put in 2,880 here. And I'm going to check the work, just to make sure the math's right. And we're okay there. So the 3,000 multiplied by 12 is 36,000. And then if you added the bonus to that, you wouldn't come anywhere near the ceiling for OASDI. But what they want you to find is the total here. So you're going to add these two together. It's 5,880. For the OASDI, we're going to take the total amount, 5,880, and we're going to multiply it by 6.2%. And that's going to give you $364.56. Notice this time we didn't have to put a minus sign in because they didn't mention that. So go figure. But anyway, that is a deduction. And when we get ready to do the net pay, we'll have to subtract it out. But you'll need to remember that we're deducting our taxes out of this. So again, the 5,880 would be multiplied by the rate for HI, which is 0.0145 if you do it in decimal, or $85.26. Now here's where it's going to get a little bit tricky for you, because remember, out of the supplemental right here, they're taxing it at a rate of, let me get that out of the way so you can see maybe a little better. They're taxing it at a flat tax of 22%. So that's your supplemental, how you figure the federal income tax on the supplemental. So if the supplemental tax is, is 22%. We would multiply that by the bonus amount of 2,880. And it's 22%. And that will give you $633.60 that they're going to take out of that bonus just for federal income taxes. I'll double check my math. Okay, so 633.60 is 22% of the supplemental amount. But then you have to look up the 3,000 regular monthly pay on the wage bracket method. And here's where you have to take in consideration the marital status. He's married, filing jointly. So married, filing jointly. 3,000 is what we need to look up. He's paid by the month. So remember, we got to look up for the month. It's monthly. Married, filing jointly, and it's $3,000. So I'm going to go to my wage bracket method. And I probably could just clicked up there and looked at it, but that's what you'd have to do. You'd have to figure out where the tax table is. It's the wage bracket method. Now we're going to find monthly. So make sure you look up the monthly payroll period. Just keep scrolling till you get there. Here's the monthly payroll period, and the amount per month is $3,000. So I'm going to enlarge this for you. And let's see. This table, yep, it does go to 3,000. So that's good. So 3,000 is what we're looking at. So you see right here from 2009-55 to 3005, the marital status is married, filing jointly. So it's going to be $91. It looks like to me. Okay. So 3,000, you look up 3,000, and that's from 2955 to 3005. This is $91 as the married filing jointly amount for that $3,000. But we got to take into consideration that it's not only $91, we got to add back that $633.60 that came from the flat tax. And that will give you a total FIT of $724.60. So I'm going to go back to Cengage, and I'm going to put in $724.60. And we're going to check our work, and we're okay there. And so the next thing I need to figure out is my state income tax. The state income tax was 2%. Notice they're combining both the salary and the bonuses together. So the combined amount was $58.80. And then we're going to multiply that by 2%, the state income tax rate, and that'll give you $117.60. Check your work. And we're okay there. And then we're going to look for the city income tax, or we're going to calculate it. And it's based on 1% of the combined amount. So $58.80, 1% of that is $58.80. And then what's left for you to find is the net pay. So we're going to take the total gross pay of $5,880. We're going to subtract out the OASDI. We're going to subtract out the HI. We're going to subtract out the federal income tax. The city income tax. And that will leave you with net pay, if I've calculated this right, at 46.78. Well, evidently I didn't calculate it right. So let me try my subtraction again. All right, so the second time was a charm. We got it calculated right now. The rest of these you do exactly the same way. So I think I've given you enough to think about today, and so we'll stop sharing this with you. And we'll see you again next time. Bye-bye.